Hey everybody, Scott Riley with the Market Update Desk. March 21st, we get the start of March Madness college basketball. So exciting time. I know a lot of people are off watching games starting about right now. Yesterday, we had the big Fed meeting. We wanted to do kind of a breakdown of the important aspects of that. The big thing that came out of that is Chairman Powell specifically started talking about reducing the balance sheet and how they're going to start to taper that. Um, Most likely within the May or June meeting, he's clearly concerned with the drawdown on the reverse repo facility, as we've been discussing. Powell said that once this is fully drained, their balance sheet reduction will drain liquidity on a dollar for dollar basis and could cause issues. He also said that if they taper and go slower, they can reduce their balance sheet for a longer period of time, but also maybe for more than what we expected. So longer and more potentially. The plan is for the balance sheet to eventually remain net neutral, meaning they get to a level that they're comfortable with and stop reducing it. This means they could actually start to reinvest some of the assets that are falling off the balance sheet back into treasuries, potentially even mortgage backed securities. This could be a big win for us in real estate with mortgage rates. He also seemed to have a little more patience on inflation, saying they'll get to 2% over time. So they're starting to recognize, as we posted yesterday, the graph, that's going to be really hard to get to 2% this year. Job growth would not deter the Fed from cutting rates. Powell also made it clear that if the unemployment rate were to rise too much, the Fed would act quickly to cut rates. Now, the Fed forecast shows that 6 Fed members think the unemployment rate will not go above 3.8 to 3.9%, while 11 think it will not go past 4 to 4.1%. So that's 17 of 19 members think they won't see unemployment raising above 4.1%, with a median forecast of 4%. We've talked about that part of the Fed's number, the unemployment numbers for BLS, talks about potentially getting to 4.4%. So we see a little bit of disconnect between the numbers of the Fed and BLS. If we get above that 4.2%, which we've been referencing, hold on, we could get some more rate cuts than what we are anticipating right now. The dot plot got a little bit more hawkish, but the median amount of rate cuts expected in 24 remained at 75 basis points or 3 cuts. The Fed increased their inflation, GDP projection, and downgraded their unemployment rate expectations. So GDP, they revised upwards from 1.4% projection to 2.1. Employment, they dropped from 4.1% unemployment to 4% unemployment. The core inflation projection was 2.4%, and now they're saying 2.6 for this year. I think that's the recognition of it's going to be really tough sledding to bring that down to 2% yet this year. Now, the Fed funds rate median of what they're expecting to fall to 4.6%. So we're getting a lot of what we wanted to hear about the balance sheet, about coalescing around how many rate cuts we'll get. And I think we walked a very thin line about them talking about 2 rate cuts versus 3. What's going to tell the tale of what's going to go on for the rest of the year is what we talked about, unemployment. If we get to that 4.2%, which I think they will, I think we could get a little quicker rate cuts than what the Fed is currently anticipating. And of course, our friend, Fed member Bauman, most likely was the very outlier of these numbers and called for no rate cuts this year and only 1 next year. Had to be her on that dot plot. Great news on existing home sales. Existing home sales rose 9.5% in February to an annualized rate of 4.38 million. That's in big contrast to what was expected at a decline of 1.5%. The inventory increased 6% month over month to about 1.07 million units. The median home price went up to $385,000. Of course, we probably won't hear Diana Olick talk about an increase in the median home. Now, the home sales remain still very tight. The average days on market did go up to 38 days on market to 36. Keep in mind, here in West Michigan, it's a lot less than that and much tighter inventory. Really interesting numbers here. First-time home buyers accounted for 26% of the sales. That was down 2%. Cash buyers, a whopping 33% of sales. That was up 1%. And investors made up 21%, increase from 17%. Cash, clearly, investors are bullish on housing, and so should home buyers be. One in five homes sold above list price, showing it's still very competitive. In West Michigan, it's going to be significantly more than 1 in 5 above list price. Keep in mind, this is national. Jobless claims, pretty much flat. Initial claims fell 2,000, and continuing claims rose 4,000 to 1.8 million. Mortgage bonds had a nice rally, but we did stop at the 50-day moving average. The 10-year tested its 100-day moving average, but did kind of fall short of it. So the market really did enjoy the day yesterday. Let's see what we get the rest of today. As you can see with those housing numbers, the time to buy is now. If you're waiting, you're going to face more competition, higher prices, and have more cash buyers and more investors fighting you. So give us a call. We can go through all the details with you and use our knowledge to help you. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. Have a great day.